Hey, YouTube family, and welcome to another video of The Kevin Strong Show. And in this video, we're going to talk about the mortgage crisis that's happening in the United States. We're going to go through a lot of graphs. I'm going to give you my little editorial comment on it. So, once again, I hope you're enjoying my content. Before I get started, I'm going to humbly ask you to smash that like button, comment, and share because I care. If you have not subscribed to my channel, I request that you do so if you are enjoying this type of content. I do apologize for getting this video out a little bit late. I had to find something in my closet that matched my complexion. Anyway, you know me, always got to make an off-color joke, pun intended. So without further ado, we're going to jump into this mortgage crisis situation. This is something that we haven't been talking about lately. It made a lot of news in the latter part of 2022, but I thought it would be a good idea to recap and give you guys some graphical illustrations as to what's happening in the mortgage crisis. So please stay tuned to the end as I share my final thoughts in terms of the mortgage outlook and the housing market at large. So let me go ahead here and switch my screen and get this set up for you guys. Once again, the title of this video is called The Mortgage Crisis. So we're going to start off, ladies and gentlemen, talking about mortgage layoffs. I've talked about this ad nauseum. So before I get started with this next slide, let me take a moment to basically just make a very, very general statement. Anytime an industry or a particular company starts to lay off its sales force, it's done in terms of any type of optimistic growth outlook. Sales department or sales gals and sales girls or whatever however you want to say it, that's the lifeblood of any company, right? That's the one, those are the guys and gals who bring the money in, that keeps the lights on, that's able, those revenues that they bring in are able to support the sales staffs and everything. So when you start cutting back on the main source of revenue, that's a telltale sign that you're not optimistic about the future. And once again, typically when you fire or lay off people who are incentivized based on commission type compensation plans, those folks are used to a certain standard of living. So they go off and either get trained in another industry or they don't come back. So it's a very, very daunting situation when you start to hear about any type of industry or any particular company laying off its sales force. So without that, we're going to go ahead and start on this. This is just some things that I was able to pull up from various sites. We're going to just go briefly through all of this, and I'll kind of give you a recap. So Homebridge is laying off 139 following CMG mortgage deal. Loan Depot cut more than half of its employees in 2022. Rocket and UWM shedded thousands of workers last year. Citigroup cut hundreds of jobs, including in the mortgage unit. Wells Fargo, you guys have heard about this last year, but just as a recap, cut off more than 500 mortgage staff on a strategy shift. But more importantly, they have basically, for the most part, just have removed themselves from the mortgage process for the most part. Equifax, the credit company, has somewhat of an ancillary function in the mortgage industry. They've laid off 10% of their employees as it relates to mortgage-related duties and responsibilities. JP Morgan Chase made cuts in its home lending divisions, and Home Point conducted some layoffs, and this last bank cut their whole mortgage division by 30%. So this is just a snapshot. I can go on and come up with multiple slides of layoffs, not only that happened in 2022, but that are happening in 2023. So now we're going to get into several graphs. So I hope for you guys who are kind of visual learners appreciate this. For those of you who don't like graphs, I do apologize, but stick around anyway because I thought the joke was pretty funny. But no, all pun put to the side. This is called the M2 money supply, and there's a crisis going on. So for those of you who don't follow this type of data, the M2 money supply is basically the velocity of which money is moving through our economy. So the gray bars basically means a recession. And as you can see back here, this graph goes way back to about 1960. And you all know what happened in 2008. That was basically what they call the Great Financial Crisis. And as you can see, the graph dipped down. I like to draw your attention all the way over to the right side of the graph. If you can see that line going all the way down, that solid horizontal line that goes all the way across the graph. So as you can see, the money supply, the velocity in which money goes through our economy has tightened up. It's the worst that it's ever been on record. This is not my opinion. This is not me selectively pulling out a graph to feed into a particular narrative. This is information I got right off the Federal Reserve Economic Data website, that acronym, which is called FRED, which is in the top left of the corner. So this is an indication that even though they don't want to say that we're in a recession, we clearly are heading towards one if we're not already in one. In my humble opinion, I think we're in a recession, and it could be a deep, long, painful one at that. As a disclaimer, I should have said this at the beginning of the video. This is not financial advice. This is just my editorial opinion, and I am a licensed mortgage broker. So this is a graph that talks about the United States single-family home prices. So as you can see, this thing has systematically gone up from 1969 all the way up to about 2008. I know you don't see 2008 on that graph, but that's in between 2002, obviously, in 2013. And as you can see, it kind of went up and down. That's a term that's called a consolidation period. It's not really moving up much, and it's not moving down much. So the marks just go up and down. And then we had the great financial crisis. That particular graph dropped down, and it didn't rebound until around March of 2012. So I would like to point out to you, for all of you guys who are just pom-pom cheerleaders about this housing market, and it is local. These are aggregate in general, these graphs. So I know there's exceptions to the rules. But back in 2008, folks, the Fed cut the Fed's fund rate down to zero during the financial crisis. And for 4 years, after they cut it down to zero, the housing market continued to go down. So what I think is going to happen the latter half of this year is that the Fed will either pivot or pause. There's a good possibility of that by the third or fourth quarter of 2023. You're going to get a resurgence of people being interested in the housing market because rates are going to come down, 30-year fixed rates. That may temporarily push home prices up. That will turn out to be, in retrospect, in my humble opinion, what is classically called a dead cat bounce. And I've explained that in previous videos, where you get a false positive, where it bounces off. It's already dead when it bounced off, but you don't know that yet. And it starts to go up because rates are low, and you folks are still going to go out there and overpay for the house instead of buying a house at the present value, at a good market value. You're going to overpay because of the interest rate. And then it's going to eventually roll back over. And this time when it rolls back over, it's going to go down much, much more. So as you can see here on the right of the graph, we hit an apex around May of 2022, and it has gone down in aggregate. Once again, there are certain markets that are actually starting to go up right now. The greater Seattle area, home prices are going up in the Seattle area. But once again, I think overly hyper-priced areas like Seattle, San Diego, San Francisco, these are classic cities that will experience a dead cat bounce. Okay, existing home sales. So as you can kind of see how this is kind of choppy a little bit. Once again, I'm going to draw your attention between 2002 and 2013. And as you can see, we had a big acceleration, and then there was a big drop. And then once again, I'm going to use a technical term. You're seeing a consolidation period, probably from around 2007 all the way around 2000 to 2012. Then you can see that the graph generally starts to trend up. Where I'm at now when I say trend up is around the 2013 mark, as you can see that. And then from 2013, it kind of went into a consolidation period. And then we had a period where we had the healthcare crisis. We had a sharp decline, and then it went back up because of quantitative easing, the government artificially pumping money into the system. It dipped back down, and then it dipped back up again, and then it went back down. So if you look to the right of the graph, all the way to the right, where my little Kevin Strong show emblem is at there, it almost looked like there's an M, the shape of an M. You see two peaks. That's what they call, it's a technical term that's called a double top. And as a result of that, it dropped down. And now it seems like the existing home sales is starting to creep back up. Trust me when I say this, you can book it. That line to the right that's curling back up, it's not going to come anywhere remotely close to where those two tops are at, or I'm describing as a double top that looks like the shape of an M. We might get maybe halfway up at best, before it rolls over. Once again, in my opinion, because you can see in this graph, we go back to 1969. And the peak might have been 2006, just look a little bit beyond 2002. And then we never really got quite to that point in terms of existing home sales. So that's what they call a lower high. We're not going to get back to the existing home sales we did as in 2006, especially when you're looking at 40-year inflation and all-time consumer debt. To me, that's just logical conclusions. Home ownership rate. I'm going to kind of speed up a little bit because I know I'm spending a little bit of time on these graphs and some people are not visual. As you can see, there's consolidation periods. There was a peak in 2006. We had somewhat of a big spike up in 2020, as I said previously, because of quantitative easing. And then there was a big drawdown beginning in May of 2022. And as you see, there's a little bit of a push up, and now home ownership is starting to roll back down again because of the aforementioned problems, inflation and consumer debt. Okay, this is what's called the United States Mortgage Brokers Association Purchase Index, aka who's buying homes and who's not. As you can see here, this graph goes all the way back to about 1990. We're nowhere near the apex of purchasing as in 2006. Even when you look at all the quantitative easing that was pumped into the system in 2020, as I draw your attention to the right side of the graph, those two peaks there aren't even remotely close to how much we did in 2006. So once again, these numbers are going to continue to go down. You're going to see little spikes that go up and down, but nothing's going to rival anything close to what we did in 2020 and definitely not in 2008. Okay, so we're getting close to the end of this video. Mortgage fallout and facts, why it matters. Private sector risk aversions have prevented millions of Americans from buying homes. It is also driving banks out of the mortgage game. That might be okay if the non-banks work disappearing too, and unlikely to return anytime soon. So basically, the translation for that is that there's a lot of people that's in the mortgage business that behind the scenes know that there's something ominous, large and in charge that's getting ready to happen in terms of default rates escalating the second half of 2023. That's why you're seeing all the massive mortgage layoffs. That's why you see people cutting back. That's why you see some of these institutional banks trying to shore up their balance sheets in anticipation of big mortgage defaults, especially in the area of FHA, where on average, the person has a much lower credit score and they put significantly less down, i.e. 3.5%. So don't be surprised if your temperature starts to rise, if you start to see an acceleration in mortgage loan defaults, especially in the area of FHA mortgage. How does it work? It works in two ways. After they originate the loan, they hold it on their books for a relatively short amount of time before selling it to the government, either directly, FHA, or the Department of VA, or both, or the agencies like Fannie Mae and Freddie Mac. So basically what that means is that there's something that's called warehouse lending and things like that. I'm not going to get technical about it because I'm trying to validate my intellect or anything crazy like that. But in layman terms, some people close the loan in their name and service the loan on top of that. That's few and far between. A lot of lenders know that there's not a lot of money to be made by servicing the loan. So a lot of times the loan requirements that you have to meet by a particular lender have to meet certain Fannie Mae, Freddie Mac, basically government guidelines. So as long as those guidelines are met, when that loan closes, that financial institution can sell that loan off to the government and then free up their capital, rinse and repeat, and do it over again. So as long as the government's buying mortgage-backed securities, there's liquidity in the system. When liquidity dries up and those pipes get dry, that's when there's a credit crunch. Lending requirements start to tighten. And even if you're in low rates and have low rates environments, it's going to be very difficult for you to secure a mortgage, which is exactly what happened in 2008. You heard these horror stories, ladies and gentlemen, when people were saying, hey, I've got a 780, 800 credit score. I can put 30% down, but I can't find a mortgage because there was a liquidity crisis in the system. After selling the loan, the originator generally continues to service it to collect mortgage payments and send them to the loan's new owner. Servicing fees are low, generally about 0.25%, and servicers need to make the payments even if the homeowner is in the arrears. That's why you'll find 9 out of 10 times who you close your loan with and who you send your payment with is totally two separate entities. So mortgage outlook, the mortgage market is now dominated by non-banks that operate with relatively thin cushion of capital and need substantial economy of scales. Between March of 2021 and January of 23, the total mortgage origination fell by 83%. This is according to Black Knight, and no, he is not my uncle. It's just a research company that deals with mortgages and real estate. I had to bring a little humor in there because this video is getting long. Refinancing, which was more than 70% of the total beginning in that period, has dropped 95%. 40% of all mortgages that exist right now have been. These folks have interest rates well below 4%. So you are not going to see refinancing in the mortgage industry pick up anytime soon, except if you see something like somebody getting a HELOC or somebody just has so much debt that they've got to consolidate into a higher mortgage interest rate. The result is that few, if any, new non-bank lenders are likely to enter the market because we're entering a period where it's just not financially feasible for a bank to get involved, not only in the mortgage industry, but more importantly, it's just not profitable because you can't go out and extend a bunch of loans and at the same time have all of this pressure for deposit demands. Remember, you're hearing all this stuff in the news about a run on the bank. So on one hand, you get all of these loans out there that are potentially going to be bad loans. They're going to go on default. You're going to have to start foreclosure procedures. That's going to hit your balance sheet. So that's going to squeeze you on this end. And then on the other end, you got the depositors that don't feel secure about the banking system saying, hey, I'm going to buy T-bills or CDs or something like that. So it's going to be drawn on the system on both ends. You're going to have to meet deposit demands. And at the same time, they're going to be experiencing massive mortgage delinquency. So sorry about the long video. I hope you enjoyed the content. So if you're still with me, I do appreciate your time. Smash that like button. Please comment and share. And if you have not subscribed to my channel, please do so. I'm going to leave you with my famous quote. Please keep your credit score up and your debt down. This was the Kevin Strong Show, and I'll see you guys in the next video.